Hello, I'm here representing Gigi Coffee Senior Berhad. Okay, so we started small but the expansion happened faster than expected. Gigi Coffee Sendirian Berhad was incorporated in 2019 as a Malaysian homegrown coffee brand. Within 5 years, the company expanded to more than 115 outlets nationwide. The expansion was supported by standardized store formats, centralized procurement, and strong brand positioning targeting the mass market. This background reflects a brewer with an established operating track record rather than a startup.
The borrower is applying for 3.2 million in financing to support its next phase of expansion. The proposed facility includes a term loan, hire purchase, and an overdraft facility. The term loan is intended to finance renovation and fit-out works, while hire purchase facility are used to finance cafe equipment. The overdraft facility is strictly for short-term working capital purposes. This structure ensures that each facility matches the nature and lifespan of the expenditure.
The proposed project involved the establishment of KK University Cafe across 6 selected UiTM campuses. This project is an extension of the company's existing cafe operation rather than a new business line. University campuses provide a semi-controlled operating environment with predictable foot traffic. The project supports stable revenue generation while limiting excessive market.
Now, ownership and management quality are key considerations in credit assessment. So Gigi Coffee is led by an experienced director and a founder-driven management team. The management team has demonstrated the ability to execute rapid expansion while still maintaining operational consistency. So basically, this reduces key man risk and supports long-term business sustainability.
Based on the business and operational perspective, Gigi Coffee Sendirian Berhad operates more than 150 outlets nationwide, indicating strong operational scalability. The company focuses on the retail, food and beverage cafe segment, offering coffees and non-coffee beverages and light food products. Operational efficiency is achieved through standardized operating procedures, trained baristas, point-of-sale system, and centralized procurement. This allows the company to maintain a consistent product quality while controlling costs across all outlets.
Macroeconomic conditions were also considered in the assessment. Malaysia's domestic consumption remains resilient, supporting discretionary spending such as food and beverage. Overall economic conditions do not pose a significant adverse impact on the proposed financing. The food and beverage industry in Malaysia remains competitive but continues to grow. The coffee segment shows strong demand, particularly among young consumers. University campuses provide a relatively stable customer base, although sales may fluctuate during semester break. Industry risk is assessed as low to moderate.
We begin the financial ratio analysis by examining the business profitability of Gigi Coffee.
During the early years of operation and throughout the pandemic period, the company recorded losses, mainly due to aggressive expansion costs, outlet setup expenses, and temporary disruptions in operations. However, starting from 2022, profitability showed a clear recovery trend. Revenue increased significantly as more outlets reached maturity and sales volume stabilized. This improvement is reflected in profitability ratios such as operating profit margin and net profit margin, which show a consistent upward movement. The improvement indicates better cost controls, economy of scales, and stronger pricing discipline. Overall, the profitability trend suggests that the core business model has stabilized and is capable of generating sustainable earnings.
Next, we assess the company's financial condition through liquidity and leverage ratio. The current ratio remains below 1, indicating tight short-term liquidity. This suggests that the company relies heavily on continuous cash inflows to meet its short-term obligation. However, this condition is common within the food and beverage industry, where inventory turnover is fast and sales are largely cash-based. In terms of leverage, the debt-to-equity ratio remains relatively high. This reflects the company's reliance on borrowings to finance rapid expansions. Nevertheless, the improving profitability trend helps to offset concerns relating to financial condition. Overall, while liquidity remains tight, the financial condition is considered manageable.
Asset management quality was evaluated using efficiency ratios. Inventory turnover is relatively high, indicating effective stock management and minimal wastage. These reflect efficient procurement, planning, and strong operational control at outlet level. Receivables are minimal as the business operates largely on a cash basis. As a result, the company is not exposed to significant credit risk from customers. Efficient asset utilization help reduce working capital pressure and support day-to-day operations.
So, from a repayment perspective, capacity is assessed based on the company's ability to generate sufficient operating cash flow. So, despite tight liquidity ratios, GG Coffee benefits from recurring daily cash inflows generated from multiple outlets. Its improving profitability further strengthens the company's ability to service its debt obligations. This indicates that operating cash flow, rather than balance sheet liquidity, is the key support for repayment capacity.
From a capital perspective, the case shows that GG Coffee sedang berakhir and significantly improved its shareholders' equity position. In 2024, equity increased to RM5.07 million from RM1.05 million in 2023, mainly due to retained earnings generated from improved profitability, although the companies remain highly leveraged with a debt-to-equity ratio of 501%. This represents a substantial improvement from 1,660% in the previous year. This indicates that while the business relies on borrowing to fund expansion, the capital structure is steadily strengthening. From a credit standpoint, the improving equity base demonstrates shareholder commitment and reduces long-term solvency risks.
In summary, financial ratio analysis present a mixed but improving picture. Profitability has recovered strongly, asset management is efficient, and repayment capacity is supported by operating cash flow. While liquidity remains tight and leverage is relatively high, the overall financial trend is positive. These factors collectively support the company's ability to meet its financing obligation.
To support the proposed financing, the borrower has pledged a freehold shop lot property as collateral. The property is owned by the company and is unencumbered, allowing it to be charged to the bank. This collateral provides tangible assets, backing to the loan and serve as a secondary source of repayment in the event of default. The use of property collateral is consistent with the bank's risk management approach, particularly for medium-term financing. By securing the facility with real property, the bank is able to reduce its exposure while supporting the borrower's expansion plan.
The freehold shop lot property has an estimated market value of 4.1 million ringgit. This provides sufficient asset coverage for 3.2 million financing, resulting in a reasonable loan-to-value ratio. In addition to the property collateral, personal guarantees are provided by the directors of the company. These guarantees reflect the directors' confidence in the business and their commitment to ensuring repayment. From the bank's perspective, the combination of collateral and guarantees significantly strengthens the overall security structure. It also enhances the bank's ability to recover the outstanding amount should the borrower face financial difficulty.
Following the financial analysis, credit risks were identified and mitigated using the 5Cs framework. Under character, rapid expansion introduces execution and management risks. This risk is mitigated by the presence of an experienced management team and established operating procedure. Under capacity, liquidity risk exists due to tight working capital. However, this risk is mitigated by strong daily cash inflows and improving profitability. Under capital, high leverage poses financial risk. This is mitigated by improving retained earning and a phased approach to expansions. Under condition, competition within the food and beverage industry present market risk. This is mitigated through the University Cafe concept, which offer a more stable demand environment. Finally, collateral provide asset-backed security and reduce the bank's overall exposure.
So, in addition to the 5Cs framework, credit risk was also assessed using the Champari model. Under character and purpose, the borrower demonstrates strong intent and a clear, productive use of funds. So, ability to repay is supported by improving operating performance and recurring cash flow. So the margin remains acceptable due to effective pricing strategies and also cost control. For the repayment risk, it is mitigated by structures facility aligned with cash flow generation. And insurance, also the guarantees, further reduce the bank's exposure. So overall, the Champari assessment supports the conclusions that credit risks are adequately mitigated.
The final credit decision was evaluated using both the 5Cs and Campari frameworks. The borrower demonstrates strong character through experienced management and a proven operating track record. Repayment capacity is supported by improving profitability and recurring operating cash flow. Although the leverage remains relatively high, capital strength has improved through retained earnings. The purpose of the financing is reasonable, productive, and aligned with business expansion. After considering all relevant financial, operational, and risk factors, the overall credit risk is assessed as acceptable. Accordingly, the credit committee supports the approval of the proposed financing.
Based on the overall assessment, a structured term loan and hire purchase facilities are recommended. The overdraft facility should be closely monitored and restricted strictly for working capital purposes. Credit security arrangements include a first legal charge over the collateral property. Personal guarantees from directors and a corporate guarantee further strengthen the bank's position. Condition precedents include execution of all legal documentation and comprehensive insurance coverage. Conditions for drawdown include satisfactory progress of the project and compliance with financing term. Credit covenants such as minimum debt service coverage ratio and periodic financial reporting are recommended to ensure ongoing monitoring.